Okay, great. Welcome to Cultivated Live, everyone. I am Jeremy Burke. I'm the co-founder and editor-in-chief. We are here with Cameron Clarke, the CEO of Sunderstorm / KANHA is their brand. Cameron, welcome to the show today.
Thank you very much. Happy to be here. Happy to chat about 2026 and all the exciting stuff that's going to happen this year.
Absolutely. Well, there is a lot going on. I think all our watchers are aware of this. Cameron, why don't you tell us a little bit about Sunderstorm's big news? We had it in our newsletter this morning, but tell us a little bit about the deal for Lime, how it came together and what's next this quarter and this year.
Yeah, for sure. So I just want to remind everybody, Sunderstorm was founded in 2015. Early 2016, we launched the KANHA brand and line of edibles. So we've been at it for 10 years. We're celebrating we just celebrated our 10-year anniversary. So super excited about that. We're operating in multiple states and actually globally now with a facility in Thailand and opening one up in Europe. So a lot happening for us. So what's interesting for us is that we always perceived that being a house of brands in the industry would be extremely valuable. We actually started with 3 different brands. It was a heavy lift for us, so we decided to focus on KANHA as we moved through 2018 and 2019 and full legalization in California. But then in a couple of years later, we bought our first brand, Bounty, and we're just announcing today that we have purchased Lime in California as well. So we are back on track to build a house of brands. We think this is really good timing to do that, and happy to chat about it here.
Can you talk a little bit about how Lime's products and Lime's consumer base complements KANHA and how you saw that being a fit? Because there are a lot of cannabis brands out there, especially in the California market, and so it must be quite challenging to figure out how to put all these puzzle pieces together.
Yes, for sure. So because we've had this interest in a house of brands for a while, we've always looked at acquiring other brands or integrating other brands. We've talked to a number. We think that it's overall a really good strategy as the U.S. goes towards full legalization. God knows when that's going to happen, but yeah, we are moving in the right direction. So with the Lime acquisition, it was very interesting. For us, KANHA has been a premium line of cannabis edibles and now premium vapes with the acquisition of Bounty. And we've launched vapes now in KANHA vapes in Illinois, and they're doing very, very well. And the acquisition of Lime was a different market segment for us. Obviously, it's pre-rolls. That's what we're focusing on. They've built a really good name for themselves in California as a top-notch pre-roll brand. They have a big following. They're also very culturally relevant. They're at the kind of in the center of the bell curve of cannabis culture in California, which is a little bit different than an edible brand, and so that allows us to attract a different kind of consumer. Also, although they're in quality wise, they're a premium brand. They also are very affordable, so they attract also a different type of consumer in that. So that's been really good for us to be able to go after a slightly different type of consumer than we would normally go after, and that allows us to build a really robust kind of branding infrastructure that goes towards different segments in the market. So number one, a different category, which is pre-rolls, and number two, different type of consumer and a flower consumer, and number three, a consumer that is cost conscious and looking for affordability. So those 3 things really are a good addition to what we've done with KANHA in the past.
Yeah, and Cameron, can you talk a little bit about how the deal came together? I mean, as a journalist, I'm always sort of interested in these stories. Deals are a little bit like marriages. There's the courtship, and then you figure out if the teams align and the quantitative metrics align. So talk a little bit about how the deal came together and how you got this thing closed.
Yeah. So for us, as I mentioned earlier, we always look at other brands. We've looked at merging and integration, M&A activity from a variety of players in the industry across the country. So we're constantly just looking for the right opportunities. And when Lime came across our plate, we saw something an organization that had actually built a pretty good brand in California, had, like I said before, was culturally relevant and had a lot of consumer recognition, and a lot of consumers said very positive things about the brand. That's great for us. They also were short on capital, and they couldn't really fulfill orders like they needed to. And so it was an opportunity for someone to come in who had the infrastructure to be able to scale that brand, had the capital to be able to scale the inventory and be able to fulfill orders, and be able to deliver to customers, time on a timely basis, and meet the demand that's already in the market. In addition to that, we have the marketing horsepower to be able to drive the brand even further into the market from where they were before. So, they had reached a pretty good level a couple of years ago of their revenue and penetration into the market, and they were struggling to meet the demand and really pursue the different retailers that they needed to get into. California is very difficult. The retailers don't necessarily always pay on time. They pay the brands where they have the proposition that product moves quickly, and sometimes other brands don't necessarily get paid as quickly, and so that requires a lot of capital to do that. So we looked at this. We said, hey, here's a brand that we can bring in house. We can easily scale up their infrastructure. We have the marketing muscle to put behind it, and we can grow it fairly easily in a very short period of time. So we can leverage the infrastructure that we've built over the years to really scale this up. So that was really good for us. And then we met the owners. We felt like it was a good match. We talked to their people. They were local in Los Angeles, so that makes it easier for us because we're LA based. And all in all, it seemed like it seemed relatively easy to plug their infrastructure into ours to get it moving quickly, and then eventually, move the infrastructure over fully under our domain so that we can manage all the costs. And I think that was one of the most important things for us is, hey, can we improve their gross margin with our very, very tight cost efficiencies, production efficiencies, distribution efficiencies. We own our own distribution in California, and all the other, software and systems that we have to be able to manage inventory and make sure that we dial in those costs very, very tightly. And what we saw was, hey, they had a decent gross margin, but we could improve it dramatically. And that was a big factor for us. We're not interested in bringing on brands or infrastructures that are bleeding, that can't control that there's no way to control their costs, and that don't have, good recognition and relevance to consumers in a market. So Lime was really a good fit for that. And we will continue to look for other opportunities as well. But, I think the most important thing that I'd like folks to know is that we've invested heavily in our infrastructure over the last 10 years. I think we have the most sophisticated ERP implementation in the industry. The MSOs have been in my office looking at our cost controls and our reporting on our cost structure, and they've been envious of what we've been able to build. And so we've actually put this infrastructure together that's ready to scale. And so to plug Lime into that, right, where we can truly manage the costs right from the get-go, was very important and allows us to really build that brand in a compelling and meaningful way. And so I think those are all the factors that really play into this and why it was a really great decision for us. And to be honest, a very good decision for Lime as well.
Yeah. Looking ahead, to the first quarter of this year, 2026 and beyond, is the strategy for KANHA and Lime to dominate California, or are you looking at other states through a sort of asset light model as well? What's the sort of grand plan? We'd love to understand that.
Yeah, so I think that's a really important question. Lime has been only operating in the state of California. Right. We're operating in 4 states, also in Thailand and soon in Europe, like I said earlier. We will be launching in at least 2 or 3 new states imminently. So we are working very hard to grow the KANHA brand nationally It's been a little difficult with the shortage of capital that's in the market. We should probably talk about that a little bit. But for us, this acquisition also makes sense because we can take that brand national as well. And so because they attract a different type of consumer, for all the reasons that I mentioned earlier, right? Different category, different type of consumer, etc. For us to be able to leverage that nationally makes a ton of sense. And we're very excited to do that. So we will be bringing Lime into other states in the very near future, and we will grow that brand. We will grow that brand nationally. And I think it's, that's a really good and important strategy for us. We are building not just a national, but a global house of brands. And that's our mission, and we're driving hard to get there.
Yeah. I want to zoom out for a second. All our viewers are aware, you're aware, Trump's executive order pushing the reclassification of cannabis, which when it goes through will unlock a lot of capital, a lot of investment opportunity for the industry, or that's at least the hope I think that many have. Let's take the 30,000-foot view look from where you sit as the CEO of Sunderstorm in LA. This is the second cannabis brand tie-up already this year. Do you expect to see more of this? Do you think that Trump's executive order will spur deal making in the sector, or do you think it'll be a little bit slower to evolve? I'd love to sort of understand how you and your team are thinking about this.
Yeah, I think that's an important question as well. I actually thought more of this would happen in 2025. That's what I was predicting early, 1 year ago.
Yeah.
And so, it didn't really happen as rapidly as I thought. But what I see out in the market is a lot of brands struggling right now. And, it's just a natural course of events where these brands will be rolled up into a bigger infrastructure that can scale them properly. So what we saw in 2025 is just a complete confirmation that investment capital just doesn't exist. So brands need investment capital to be able to scale their brands into other markets. These licensing deals really don't make a lot of sense. They're not good for the long term. So you need to go build your brand properly in other markets. That's very different than other CPG types of companies. So the only investor capital that's available today is really debt capital. It's very expensive, and you really should only take it for the short term, because over the long term, it will kill your business. So a lot of these brands have taken on debt just to survive, and now that debt is a noose around their neck, and it's really impacting their ability to operate properly. And so, I think in 2025, that confirmation of the lack of the dearth of investor capital really was just hit home. And so brands started realizing, and manufacturers just started realizing, hey, we just don't have what it takes to scale. Now, on top of that, you have the MSOs that are not acquiring brands, right? Because they're short on cash. Their stock prices are too low. So they're not really in the market to acquire brands either. And then, you have the brands themselves that, just can't get to scale, right? You cannot cash flow in this industry, except in an early market. You cannot properly cash flow in this industry unless you get to scale. And I think that was proven in 2025. I encourage, everyone on this call to go start looking at the balance sheets and looking at the P&L of these companies to see that the only ones that are really cash flowing and the only ones that are profitable are the ones that can get to scale. There's a massive difference of selling, $250,000 a month in product and selling $2 million a month in product, right? And so there's a lot of these brands that are just hanging on, but I think they're starting to get a little bit worn out. They're realizing that they've got to do other things. I think the integration from our competitors was a slightly different story, but I think that the brand there was an understanding that the brand needed cash as well, and so I think that was one of the reasons that deal was done, and it does make sense. Right. We actually have been looking at these kinds of integrations, like I said, for a long time, And I think we're finally entering the year 2026 when you're going to see a lot of this. It makes a ton of sense for multiple brands to get together and get to scale. And what is the definition of scale? Well, I'll tell you from my perspective, scale means really getting to $100 million a year in revenue. That's really what scale means in this industry. We're not quite there yet, but we're well on our way, and that's what we're driving towards. So, you will see more integrations from brands across the industry in 2026 for these reasons. But you'll also see integrations from other types of companies, right? So we saw 2 distributors in California that merged together recently. That makes sense. You will see more of that. So it's just, I think there's just a realization in the market that you've got to be cost competitive. You've got to understand your cost structure. You got to get to scale. These low price brands that are driving the prices down are not going to go away. They're here to stay. And as soon as one dies off, another one's going to pop in there. And it's just a fiercely competitive market. And so you got to get to scale to cover the cost of your infrastructure. That's the bottom line.
Yeah. Well, Cameron, we're just about hitting time. We appreciate all your insights and perspective. We'll check in with you guys again, maybe in 6 months or so, to see how the deal is unfolding and whether there's more deals on the radar. You are Cameron Clarke, the CEO of Sunderstorm. I am Jeremy Burke, the co-founder and editor-in-chief of Cultivated. We will see all of you tomorrow. Thank you so much.
Thank you.